Warren Buffett has $325 billion of cash, the most ever at Berkshire Hathaway. Why do you think he has a third of $1 trillion in cash? Because he can see what's coming. Have a slice of gold. I recommend 10%, seasoned to taste. And gold is an inflation hedge, but that's not the main reason to have it. Right. I'll answer the question, Joe, but people will just roll their eyes. The best way is diversification. Everybody goes, "Oh, we know that diversification, yeah, yeah, yeah," but they actually don't know what it means. People say, I run into people, well, I'm diversified. I've got 50 stocks in 10 different sectors, semiconductors, minerals and mining, consumer non-durables. I'm fully diversified. And I say, no, you're not. You may have 50 stocks in 10 sectors, but you have one asset class. It's called stocks. And when they go down, they're all going to go down together. So that's not diversification. Have a slice of stocks, sure. Have a considerable slice of cash. Warren Buffett has $325 billion of cash, the most ever at Berkshire Hathaway. Why do you think he has a third of $1 trillion in cash? Because he can see what's coming. Have a slice of gold. I recommend 10%, seasoned to taste. And gold is an inflation hedge, but that's not the main reason to have it. Gold is what I call the everything hedge. It hedges inflation, also hedges geopolitical risk, social breakdown, potential for war, hedges a lot of things, and it belongs in every portfolio. And then, have your alternative, treasury notes, a 10-year treasury note. They've been going down in price lately. When yields go up, prices go down. It's, like a seesaw. So lately, 10-year treasury note yields have been going up, but they're probably close to a cyclical peak, and they're going to start to go down. So you can have big capital gains on your 10-year treasury notes. If that's a little too volatile, look at the 5-year or the 2-year note. So treasury notes, cash, gold, and some stocks. I like defense and energy and a few other sectors. That's a diversified portfolio, and that will serve you very well. That's correct. His term ends in early 2026. So we may be in and out of a recession between now and then. I expect we will be if it doesn't get worse, if it doesn't turn into a monetary crisis. But the point being, yes, his term ends, I believe, it's early 2026. I think February 2026. So what's the rush? Get through a bad patch, get through a recession, and then name a replacement early next year when things will probably be better. Well, I don't think that's the vibe. That's my own analysis, and there are a lot of indicators that point to that. And cutting rates doesn't matter. By the way, low interest rates are associated with recession and depression. The idea that we'll cut interest rates and will stimulate the economy is nonsense. The lowest interest rates were after the 2008-2009 global financial crisis, and also during the Great Depression. I spoke to Ben Bernanke about this. Interest rates in the Great Depression were rock bottom. So interest rates are now stimulative. When your economy is going well and your real growth is, say, 3 or 4%, and a little bit of inflation on top of that, interest rates should be 5 or 6%. That means people are borrowing, they're lending, they're spending, they're investing, businesses are expanding. That kind of strong economy is associated with somewhat higher interest rates because there's a competition for funds. When you see interest rates below 2%, maybe even 1% or lower, and that's where they're headed right now, that's a sign of recession. But there are many other signs, without getting too technical, what they call swap spreads. Why would I take a lower interest rate from a bank than I can get from a federal U.S. Treasury security? Well, the answer is because the bank deal is off balance sheet. That shows you that bank balance sheets are constrained. They're reducing their balance sheets. And as I said earlier, the Fed puts on a good show, but it's just a show. The money that counts, that's loaned and spent and invested and drives the economy, doesn't come from the Fed. It comes from commercial banks. And right now they're pulling in their horns. No, and you're right about the first thing. The dollar has gone down in value, but it was from a pretty high level, not the highest. The highest of all time was January 1985. That's when Baker had the Plaza Accord. But it has come down. It come down in the last several months. You're absolutely right about that. But that's from a fairly high level. So the dollar is still very strong. But that is a different metric than the status as a global reserve currency. And I explain to people, there's no such thing as a global reserve currency. When you have reserves, you don't hold them in currencies or cash, you hold them in securities. And so what it actually means is that countries have U.S. Treasury securities in their reserve positions. Now, yes, they're denominated in dollars, so you can say dollar for shorthand, but it's really Treasury securities. So when you ask yourself, will the dollar lose its status as the global reserve currency? What you're really asking is, will U.S. Treasury securities lose their status as the number one reserve asset? And the answer is no. And the reason is there is no alternative. There's no, the other biggest bond markets in the world are Japanese government bonds and Italian government bonds, and Germany's third. So if you don't like U.S. Treasuries, do you like JGBs better? Do you like it? Do you like Italian debt better? The answer is no. I mean, by the way, the Italian and German debt is denominated in euros, but they're not backed by the full faith and credit of the European monetary zone. They're backed by whatever government, Italy or Germany. So A, those markets are not big. B, they're only as safe as the Bank of Italy or the Italian government. So U.S. Treasuries look very attractive relative to those. Even in a world where the dollar is going down in terms of exchange rates, the U.S. Treasury is not, Treasury securities market is not threatened as the leading global reserve asset, is the way I would put it. One of the reasons that the mainstream economists, who actually know very little about economics, they've got a lot of flawed models, but one of the reasons they were saying it was going to tank the economy, there were a couple of reasons. Number one, that tariffs would cause inflation. Because you put a tariff on a good that raises the price, that's going to cause inflation to consumers, and that's going to then the Fed will have to keep interest rates where they are, maybe raise interest rates, and that was going to slow down the economy. Now that's their analysis, but it's completely wrong. And here's why: when you have tariffs, basically you've got three parties involved. You've got an exporter, let's say they're in China, but it could be elsewhere. You've got an importer. And you've got a consumer who buys the end goods. So there are three, maybe more, but at least three parties. The one who actually writes the check and pays the tariff is the importer. At the port of entry, they receive the goods, they got to pay the tariff, and that's that. But it doesn't end there. The question is, who actually bears the cost? Now, the mainstream economists are assuming that they would just pass along to the consumer, but that's not true. What happens is either the importer turns to the producer and says, hey, you have to lower your prices to me to make up for the tariff, or I have to take smaller margins. So maybe the importer and the exporter split it. They both have reduced margins and reduced revenues. The one place it does not go is to the consumer, because candidly, the consumer is a little bit tapped out right now. Credit card balances are up. Credit card defaults or delinquencies are up. Auto loan delinquencies are up. So if you could raise prices to consumers, you would just do it. You wouldn't need a tariff as an excuse. So the point being, tariffs don't cause inflation. They will not cause higher interest rates. There is a cost, but it gets pushed back to the producer or the importer. So it doesn't slow the economy the way the mainstream economists said. I don't think it will hurt the MAGA agenda or the White House agenda. It's not going to slow down the what do they call it, the big beautiful bill or beautiful big bill, whatever it is. It's not going to slow that down. Trump is going to prevail. Candidly, I almost feel a little bit sorry for Elon Musk. He ends up as what they call the man without a country. He alienated the left and the progressives by hanging around the White House in Mar-a-Lago and being friends with Trump. Now he's alienated the MAGA group because he's criticized Trump, he's called for impeachment, et cetera. So he's got no constituency left because he's alienated both sides. It does go to show that look, I'll give Musk credit. He's some kind of genius. Hard to know what kind, but he's some kind of genius. Enormous industrial and technological accomplishments, and the world's richest man. Okay, that's 3 for 3. But he was kind of a little bit like Trump in his first term. He doesn't know Washington. Trump knows Washington now because he's been elected twice, and he's I would say 3 times if you count 2020. But he certainly put a great team together, and he learned some lessons in the first term. Musk comes in, he doesn't understand Washington, doesn't really know how it works, and he's alienated both sides. The other thing is, either Elon got really bad advice, where sometimes when you're that rich and that powerful, your associates are kind of afraid to speak up to you. They're kind of yes men. I mean, holding the astronauts hostage was a really stupid move. He could have done a lot, to advance his position without saying, we're going to take a Dragon, that's a spaceship, SpaceX offline, decommission it and strand the astronauts. He reversed course on that today. So I guess someone finally got through to him and said, why are you holding astronauts hostage? Everyone loves astronauts. And by the way, they're people. We should care about them. So a little bit emotional, a couple of dumb moves on Elon's part, but Trump's going to win. I actually thought Trump was very restrained. Yeah, there were back and forth postings on X and name calling and all that. But Trump was the one who was kind of, trying to calm things down. Musk was a little bit out of line. So Trump's going to prevail. It's not going to derail the agenda. The loser in this, at least in the short run, is Musk. But I do expect that they'll kind of kiss and make up at some point. Well, they actually won't. I mean, Musk has about criticism about spending and deficits being out of control. The question is, what is the definition of being in control? And Musk said something that was just dead wrong. He said, a company goes bankrupt, spends more than they make, they go bankrupt. A country's the same way. Country's not the same way. I mean, they're different. He's right about a company. I'll leave that to him. But it shows that really smart, really rich people don't understand monetary policy and fiscal policy. So here's the best analysis, Matthew, and I hope I don't sound heretical, but deficits don't really matter unless you put them in the context of growth. The national debt doesn't really matter unless you put it in the context of GDP. So you can't just say, oh, it's 38 trillion. It's a big number. Yeah, it is a big number. The question is it scary or not? Is it dangerous or not? And to answer that question, you have to compare the debt to GDP. Now, right now, it's at an all-time high. That's a bad thing, and it impedes growth, and we need to fix that. So I agree with that. You have about 38 trillion $38 trillion of debt, and GDP is about 27 trillion. So it's, let me do the math, it's like 125%, give or take, the highest in US history. All you have to do to fix the problem is you have to grow the debt more slowly. We're not going to have surpluses for the foreseeable future. The debt's not going to get paid off. It doesn't have to get paid off. It does have to get rolled over. And that's the key to sustainability. Will the market absorb additional treasury debt? Right now, the market is hungry for that debt. They can sell as much as they can print. But what do you have to do? You have to get the deficits down to around 3% of GDP. Then you have to get growth up to real growth, about 3% of GDP, and then you have 2% inflation. I don't like inflation any more than anyone else, but 2% is the Fed's target. So 3 plus 2, I promise the math will be simple. 3 plus 2 is 5. So 3% real growth plus 2% inflation is 5% nominal growth. And in this analysis, you look at the number, it's a nominal analysis. So if the deficit and additional debt is growing at 3% a year, and the economy is growing 5% a year, 3 real plus 2 nominal. What does that mean? It means the debt is growing more slowly than the economy, which means the debt to GDP ratio is going down, and that's what you want. And believe me, if you get to that, this is what Scott Bessent wants. He called it the 3 arrows before he was named Secretary of the Treasury. I haven't heard 3 hours lately, but 3 hours lately. But it's 3% deficits, 3% real growth plus 2 inflation, and 3 million barrels of oil a day. He called it the 3 hours. If you can do that, the markets will cheer. The Treasury will be able to sell all the debt they want. Now, it's not easy. The math is easy. But doing it is not easy. But my point is, you're never going to pay off the debt, and you're not going to make the deficits go away. You just have to grow deficits more slowly than you grow the economy, and that will solve the problem.